Welcome to today's Explainer. Look, we're unpacking a truly fascinating mystery today in the world of personal finance. Imagine a guy who spent years, literally years, loudly and relentlessly explaining to absolutely anyone who would listen exactly why putting 100% of your money into global stocks is the absolute best move you can make, and then he just abandons the strategy entirely. Why in the world would a diehard index fund champion completely flip his investment philosophy upside down?
Okay, let's dive into this because it's wild. A relentless advocate for 100% equities just cut his stock exposure in half. I mean, it's a massive pivot that completely shocked his followers. He didn't just tweak his portfolio, he fundamentally restructured his entire approach to risk. And to understand why a 100% stock guy would pivot so drastically, we really have to look at the undeniable math he was wrestling with behind the scenes.
Because on one side of the scale, you have the undeniable math, right? Historical data proves that equities have beaten inflation by 5 or 6% a year for over a century. It's practically a compounding miracle. But on the other side is a really harsh, stomach-churning reality. At some point, the market is going to fall 40% from peak to trough. It's absolutely guaranteed to happen. You just never know when that terrifying drop is going to hit.
Section 1. The Big Portfolio Pivot. So before we can understand the pivot itself, let's look at why he chose that path to begin with, and the foundation of his original maximum growth philosophy.
He was all in on equities for a few really brilliant reasons. First off, the long-term data is just overwhelming. If you hold a broad global index for decades, global stocks just win, period. But the second reason was arguably way more important: radical simplicity. By using a single global index fund, it was just one button to press. More money in, no second guessing. It completely eliminated that dangerous behavioral trap of overcomplicating things. No picking stocks, no daily tinkering, and no hurting your own returns just because you think you can somehow outsmart the market.
Section 2, 3 questions for your money. So what broke that perfectly simple system? Well, it wasn't the market at all. It was his own life. And he actually evaluated his need for change using a very specific framework. I want you to ask yourself this right now. When should you actually dial down your risk? We are told our entire lives to just build, and grow. But at what exact moment do you finally take your foot off the gas pedal? He ran his decision through 3 distinct steps. 1. Risk appetite, meaning how you actually feel in your gut about taking a loss. 2. Risk capacity, meaning can you economically afford a loss without it totally ruining your life? And 3. Time horizon, like how long until you actually need to spend the money. Now here's the absolute secret to his pivot. His capacity and his horizon, they didn't change at all because his business still pays him, but his risk appetite completely shifted. Why? Because he finally hit his number. Section 3. Finding your enough. This really brings us to the emotional core of this entire explainer. The exact moment you hit your number, the entire game changes. Your goal shifts entirely from simply growing the portfolio to actually living the life. Now, what's really interesting about this is how people figure out that enough. A common starting point is the famous 4% rule. Basically, you start with the income you need for the lifestyle you want and you just work backward. The idea is that if you withdraw 4% of your portfolio in retirement, your money should outlast you. But, it's not a perfect science. The harsh realities of the market require a little bit more planning. Think of it vividly like this water tank metaphor. Imagine a big tank of water. If your investment returns pour in at about 5% a year and you drain out 4% for your living expenses, the tank stays roughly level. Sounds perfectly safe, right? But here's the catch. That water tank is sitting on a boat, out in very rough, highly unpredictable seas. The market is going to have bad years, which means a financial buffer, a cushion, is mathematically necessary so you don't drain the tank completely dry when those waves get super choppy. But finding your number isn't just a math equation, is it? It's deeply human. He asked himself what he actually wanted from life. He imagined himself in a Lamborghini, wearing gold chains, hanging out at aspirational clubs, and realized, you know what? That just isn't me. True contentment for him was literally walking his dog, Teddy, out in the woods. He loved cheap hobbies. Realizing that all those stereotypical status symbols didn't actually make him happy is exactly what allowed him to stop endlessly reaching for maximum growth. Section 4. In defense of boring bonds. So, knowing his enough meant his risk appetite completely plummeted. He just didn't want to ride the wild roller coaster of a purely stock-based portfolio anymore. It was finally time to embrace the boring.
He completely restructured his assets into this really classic split, 60% equities, 40% fixed income, mostly bonds. And the mechanics here are beautiful. If stocks keep rising, he still captures 60% of that massive upside. But if stocks fall, he has a safety net. He can do a simple yearly rebalance, taking money from his safe, boring bonds to go buy those now cheaper stocks. It's a mechanism that a 100% equity investor simply does not have.
And this brilliantly illustrates exactly why he became such a champion for bonds. People think they understand stocks, but a stock really represents an unknown future and totally unknown cash flows. Let's be honest, you don't even know if the company is going to exist in 10 years. But a bond is a contract of certainty. You get an exact cash flow on an exact date and you get your money back. In a deeply chaotic world, buying bonds is literally buying certainty.
Section 5. The danger zone. Because look, no portfolio is invincible. Even with a brilliant 60-40 split, there is a specific economic danger zone that terrifies even the most balanced, seasoned investors.
It's called sequencing risk. This is the absolute danger of having to sell your shares to fund your life right after a massive market crash. Think of it like scooping a fixed amount of money off a shrinking pile. If your portfolio gets cut in half by a crash, that fixed scoop you need for groceries and rent, it suddenly becomes a massively larger percentage of your total wealth. It rapidly drains your portfolio, making market crashes right near your retirement absolutely devastating.
To fight this, he actually looked past rigid rules like that old 100 minus your age formula. Instead, check out this incredible, totally counterintuitive approach, the reverse glide path. Basically, you start your early retirement with really low equity to dodge that early sequencing risk. Then, as you age, you actually increase your equity exposure. Crazy, right? But a 30 or 40-year retirement is still a massive time horizon, and backtests showed this strategy works surprisingly well to dodge early disaster.
But there is still one thing that keeps him up at night. What happens when bonds just stop acting like a safety net? Normally, stocks and bonds move in opposite directions, but an inflation shock completely breaks that hedge. Driven by pandemic money printing, supply snarls, tariffs, energy shocks, inflation over 5% is just toxic. It eats away fixed income, and it forces stocks to be re-rated downward. So suddenly both your safe bonds and your growth stocks are falling together. No way out.
Because these inflation shocks are becoming more frequent, he completely avoided swinging long-dated government bonds that bounce around wildly when interest rates move. Instead, he found the ultimate safe haven, money market funds. They have almost zero duration risk and almost no credit risk. It is just boring, steady, decent income. And honestly, when you're trying to protect your entire life savings from inflation, boring is exactly what you want. Section 6. Keep your bags packed. Let's move to and see how this builds into the final synthesis of his entire new philosophy. Knowing that markets will inevitably drop, how do you actually live your life without constant anxiety?
Well, he leans on a brilliant piece of wisdom from his grandmother. She used to say, "At my age, you keep your bags packed." What she meant was, you must always be ready for the next crisis. You can't predict when that 40% drop will happen, only that it absolutely will. So if you're nearing retirement and entering drawdown, you better have your financial bags packed with really safe assets like cash and money market funds. But what if you're a younger viewer? If you're still in your accumulating years, a 40% market fall is not a disaster. It is a profound gift. You are literally buying the exact same world-class assets on a massive sale. The markets have historically always snapped back. You just have to be financially and emotionally prepared to stomach the ride without panicking.
So, the crucial point is this: there is no universal right answer. 60-40 isn't magic, and 100% equities isn't a death sentence. It all depends entirely on your life. What does your enough look like? Have you actually matched your financial risk to the life you truly want to live, or are you just mindlessly chasing maximum growth for a lifestyle you don't even care about?
Just as a quick reminder, this explainer discusses one investor's specific views and is for educational purposes only. It's not investment advice, and you should definitely always do your own research before making financial decisions. Thanks so much for joining me on this deep dive, and I will see you in the next explainer.